Let's talk about the perpetual method of maintaining the inventory. So as I buy more inventory, let's assuming I don't pay for it, I'm just going out and ordering. I want 100 rolls of Scott paper towels because I'm going to resell it to my customers in Target. I just go out and order it. So as you can see, I am debiting inventory and crediting accounts payable for purchases. This is how it's done under the perpetual method. You go directly to inventory. Under the perpetual method, all of your inventory purchases go directly to inventory. Remember, I said under the perpetual method, you're updating inventory immediately. And then when you sell it, you're updating cost of goods sold. Let's look. Now you sold on account, you sold some of your products. And this is your sales price, $1 million. All right? You sold it. Now, once it is sold, I have to update inventory and cost of goods sold. So under the perpetual method, I'm going to debit cost of goods sold and credit inventory. Remember, my inventory is going down because I sold it, and my cost of goods sold, which is an expense, goes up. You always debit expenses. So I'm debiting cost of goods sold, and I'm crediting inventory. This is how you do this under the perpetual method. Generally speaking, most companies that have a perpetual method are constantly doing this for purchases and sales. Inventory is going up for purchases, inventory is going down for sales, cost of sales is going up, all right? So every sale, two things is happening. One, you're recording the sale, whether cash or credit, as they're doing here. And then two, you have to also record the cost of the item that you sell. So under the perpetual method, two things are happening at the time of sale. First thing, record the sale. Second thing is show the corresponding decline in inventory and increase in cost of goods sold as they show it. So that's why it's numbered to A and to B. They're all two, but there's two simultaneous things happening at one time. The sale recorded and then the inventory being decreased with the increase in cost of sale. Now, the inventory is at cost. It's at cost. That's why it is the cost of the good that's sold. The sales price includes the markup. I sell watches. I am selling a watch for $1,000 that cost me $100. I am selling one watch for $1,000 that is costing me $100. So here, I would show the watch at $1,000, all right, assuming it was purchased on credit. I would debit accounts receivable for $1,000, credit sales for $1,000. Correspondingly, I'm going to have to show the cost of that watch by debiting cost of goods sold for $100 and crediting or reducing inventory for $100. Those things, two things happen on every sale. I am recording the sale, then I am recording the reduction in inventory and the increase in cost of sale. That happens all the time in a perpetual method. Most companies that use the perpetual method have what they call a point of sale system. That point of sale system does this automatically. It records the sale and it records the decline in inventory. So at any point in time in a point of sale system, because it's automatically updated, you can say, what's my balance in ending inventory? Boom, you have it. What's my total sales for the month? Boom, you have it. Because it's an automatic thing that's being done. This is what's being done in that point of sale system behind the scenes. As you buy inventory, you enter it into the point of sale system. As it's being sold, it gets reduced by the point of sale system and cost of sale gets recorded. This is how you can record this in a perpetual methodology. The next step is we're going to go into the periodic. The periodic methodology is just a little bit different. What you have is an intermediary account called purchases. What you will show as you buy inventory, you record it as purchases. You do not record it as inventory. You record it as purchases. So the periodic method will record every inventory purchase as a purchase, Let's assume it was on account with accounts payable. And then when this sale happens, you would debit accounts receivable and sales. That happens. That's point A. All right? That's point A. Now, under the periodic method, remember there's two parts to this thing. Now you have to look at how do I determine my adjustment to cost of goods sold. Now, remember under the periodic method, you've got to take a physical count. Let's read. Suppose a periodic method count was done on December 31st, which resulted in the determination that the inventory, ending inventory, at December 31st is $348. The necessary adjusting entry. So the periodic method requires an adjusting entry after a physical count was done. If you remember when we dealt with office supplies and adjusting entries in chapter 3, we talked about a physical count of office supplies. It was an example in problem 3.1. We bought office supplies for $3,000. Right after that, it said that $2,000 of that office supplies was used. How do we know that? We took a physical count. We took a physical count subsequently and determined there was only $1,000 worth of office supplies on the shelf. That physical count tells us that we now have to take that $3,000 in office supplies and reduce it to $1,000, which we physically counted. Therefore, we have to do an adjusting entry of $2,000. Same thing with merchandise. Going back to this problem. We did a physical count on December 31st and determined that inventory was, the ending inventory amount was $348. This is how we do the journal entry. So we look at this journal entry and we say, okay, we got $800,000 in purchases, all right? And now we sold, it looks like $950,000 of the inventory was sold. So to adjust it, we have to, let's look at the problem, just pause right there.